In 1914, as the first shells fell on Sarajevo, a small private bank in Vienna quietly moved its gold reserves across 3 different borders. By 1918, the Austro-Hungarian Empire had collapsed. The bank remained. In 1938, as Nazi tanks rolled through the Sudetenland, the same institution transferred its ledgers to a basement vault in Zurich. The Third Reich fell. The bank endured. Between 1989 and 1991, the Soviet Union, Yugoslavia, and Czechoslovakia ceased to exist. Their currencies became worthless paper. But in a modest building on Bonhoefstrasse, the descendants of those 1914 bankers still counted their profits. This is another video where money, power, and history collide. Nothing is ever as simple as it looks. Most people believe banks are tied to countries. When nations fall, banks should fall with them. The textbooks teach us about financial institutions as extensions of sovereign power, central banks printing national currencies, commercial banks serving domestic markets, regulatory frameworks binding finance to territory. Wegelin Co. Private bankers told a different story. Founded in 1741 in St. Gallen, Switzerland, it became the oldest bank in the country. But age alone doesn't explain survival. Cockroaches are old too. What made Wegelin different was its relationship with nations themselves. While other banks served countries, Wegelin served the people who outlasted countries. The secret was simple. Wegelin never confused governments with wealth. When the Habsburg Empire stretched from Milan to Krakow, Wegelin's clients weren't the empire itself, but the Austrian nobles who knew empires don't last forever. When those same nobles fled Vienna in 1918, their accounts simply moved with them. The bank had learned the first rule of institutional survival. Your client's money is more reliable than your client's flags. Consider the mechanics. Traditional banks lend to governments, finance national projects, align their fortunes with political power. They become extensions of state machinery. When states collapse, they collapse too. Wegelin operated like a financial relay race. As one runner fell, another picked up the baton. Austrian aristocrats gave way to German industrialists. German industrialists gave way to Swiss manufacturers. Swiss manufacturers gave way to American entrepreneurs seeking European discretion. The money kept moving. The bank kept taking its percentage. The institution developed what historians call financial neutrality, a position more absolute than Switzerland's political neutrality. They would serve anyone with sufficient wealth and sufficient reason to preserve it beyond their government's lifespan. This wasn't patriotism or ideology. This was mathematics. Swiss banking secrecy laws, passed in 1934, provided legal infrastructure for what Wegelin had practiced for 2 centuries. The laws made it criminal for banks to reveal client information. But Wegelin's real protection wasn't legal. It was structural. The bank remained small. Never more than a few dozen employees. Never more than a few hundred clients. It avoided the temptation to grow large enough to threaten anyone or small enough to be ignored. It found the perfect size for invisibility. During World War II, while major Swiss banks collaborated with both Allied and Axis powers, Wegelin simply waited. Their clients' gold sat in vaults. Their clients' bonds earned modest returns. The bank collected fees. When the shooting stopped, the clients emerged from whatever holes they'd hidden in. The accounts were waiting. This pattern repeated through the Cold War. Hungarian Revolution in 1956. Prague Spring in 1968. Polish martial law in 1981. Each crisis sent new clients westward with new money seeking new discretion. Wegelin's client base read like a refugee list of European political upheaval. But the bank's survival strategy contained its own destruction. By 2000, the world had changed. Financial transparency laws tightened. International cooperation between tax authorities increased. The United States, in particular, began demanding information about American citizens hiding money overseas. Wegelin's business model depended on secrets. When secrecy became impossible, the model collapsed. In 2012, American prosecutors indicted Wegelin for helping U.S. citizens evade taxes. The bank faced a choice: reveal client information or face criminal prosecution. After 271 years of operation, Wegelin chose to close rather than betray the principle that had ensured its survival. The partners sold the bank's non-American business to a competitor. They paid $57.8 million in fines to the U.S. Justice Department. They shuttered the institution that had outlasted the Holy Roman Empire, the Habsburg monarchy, the German Reich, the Soviet Union, and Yugoslavia. The irony was perfect. The bank that survived the collapse of 5 countries was destroyed by one country's tax law. The story reveals something uncomfortable about institutional survival. Wegelin endured because it served wealth's desire to escape accountability. The bank's clients weren't fleeing persecution. They were fleeing taxes, regulations, and obligations to their fellow citizens. Modern offshore banking follows the same logic. The Cayman Islands, Panama, Luxembourg, they serve the same function Wegelin served. They allow wealth to exist beyond the reach of democratic institutions. The names have changed. The behavior hasn't. Today's financial institutions face the same choice Wegelin faced in 2012. Serve transparency or serve secrecy. Serve democratic accountability or serve private accumulation. Most choose a middle path: public compliance with private evasion. Cryptocurrency advocates often claim they're building systems beyond government control. They're not innovating. They're digitalizing what Wegelin perfected with paper ledgers and vault doors. The pattern persists because the tension persists. Wealth wants mobility. Democracy wants accountability. These desires cannot be reconciled. Wegelin's story suggests that institutional survival depends not on serving society, but on serving the people who can afford to outlast society. The bank succeeded because its clients expected their money to survive longer than their countries. They were usually right. The customers who moved gold across borders in 1914 understood something most citizens never learn. Nations are temporary. Wealth finds a way to continue. Perhaps the most troubling lesson is that Wegelin was probably right. The bank collapsed not because its model failed, but because one government finally became powerful enough to enforce rules globally. The question isn't whether such banks should exist. The question is whether any government will remain powerful enough to prevent them. Money remembers what nations forget. Survival is not about loyalty. It's about knowing when to leave.